Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, John Briggs and Joann Spadigam. Okay, John, I think it's treasuries that have still mostly been leading the way this week. So let's start there. Last week we had Deepika on, our US economist. She went through the kind of inflation data last week, the CPI data, how that's impacted our economic views, how it's shifted our Fed call. But what we didn't get out of that discussion was how it's kind of shifted our US rates views. So I'd love for you to shed a little bit of light on that for us today.
Thanks, Imogen. It's good to be back on Bondcast once again. So, the way we're thinking about the U.S. rates market is that it's going to have some significant challenges going forward. And I think the way we like thinking about it, breaking it down, is differentiating between level and time. From a level perspective, as you said, Deepika mentioned that we still have the Fed doing an easing cycle. It's a little bit more delayed, starting in September, something that is notable because you have an election window there where if they do want to get it started, they should start in September. Otherwise, it's a little bit binary. Then you're pushing yourself to December, which is impacting market pricing. We'll come back to that. But we do have the Fed doing 325 basis point eases this year, September through December. So one can make an argument that with what's priced in now, if you look at between now and the end of the year, you've got about 40 basis points priced in. That's less. So you could think that we might suggest that front end valuations are attractive. I think they are on a conceptual basis or for very long-term investors. The problem is time. In a negative carry environment and at a time where, in our opinion, after three CPI prints that are unfavorable to the market, frankly, of the Fed outlook, that you are going to need at least two and maybe even three more favorable inflation prints for investors to get their heads around that we are indeed going to be embarking on a rate cut cycle, that you are going to have favorable enough conditions to do it. And with a strong growth backdrop, it's reasonable for the market to ask the question of why should they be going at all? Is there a chance that there even is a hike? We're not in the hike camp by far, and I think that's a hard yard for the Fed to get to at this moment. But if you continue to see upside inflation surprises, it's going to be harder and harder to write off that you should have some probability of a hike priced in the market, even if it's not a base call. So you've got a lot of time between now and when even bond bulls can have some assurance or evidence that the disinflationary process is back on track, and that you can start wading back into the market. Until you get there, we're probably looking at a higher choppy higher rate range. If you want to look at simply Fed pricing, somewhere between 25 basis points of cuts and 50 basis points of cuts, plus or minus 10. I do think, to be fair, that the market's going to have a hard time pricing out more than one cut at this point. It is only April. December's a long way away. So, if you want to take a tactical approach, if you get twos north of 5%, we're probably could see some buying, and on a tactical basis, not a bad idea. But you really don't have a lot of tailwinds here. Same time, I'm not sure if until you get some evidence inflation slowing, disinflation process is beginning again, is the market going to really price in more than three cuts or even get up towards three cuts? Again, I think that's a high hurdle at this point. So higher rate range in a negative carry environment, it's hard to be particularly bullish.
You mentioned there that it was hard at this juncture to kind of envisage us being in a scenario where we're, really pricing in hikes from the Fed. But it must be on your mind that we could get to a scenario, well, like you say, not perhaps yet, given that it's only April, but as we transition through the year, there must be a chance, an increasing chance that the Fed doesn't cut at all. How are you thinking about that, I suppose, at this point?
Like I said, it's not in our forecast, but in the end, it doesn't really matter what I think. It matters what I think the market's going to start thinking about, and they're already starting to think about that. Just judging by the questions that we get from clients, just judging from the pricing distribution that you see, it's not unreasonable. I mean, it's hard to push back on an argument now where you say, well, this level of policy rates should weaken the economy, should loosen the labor market, and should bring inflation down. That story looked great in the end of the year. We had actually inflation performing better than expected. We've now had a quarter of it performing worse than expected. We don't think you need additional restriction. It may be monetary policy lags are just longer now after a decade of low refinancing for consumer mortgages, for corporate debt levels, and no refinancing walls and better, very strong balance sheets on both sides. So maybe it just takes longer. But then again, I also want to be open to the idea that market pendulum swings very quickly. In the second week of January, we had 170 basis points of Fed price in this year. Now we have 40. So could a couple good, more favorable or prints that, just perhaps bring that, end that rate hike discussion, bring things into better balance, come in a few months? I think actually probably will. The problem is right now that's still a long time to wait. So unfortunately, it feels like I said, time's just working against you.
Yeah, that makes sense. I guess when you say, it doesn't take much for the momentum in the market or that pendulum to swing completely in the other direction, we've had certainly a couple of days of that over the last few weeks when geopolitical risks have kind of, overtaken this kind of monetary policy cycle in terms of themes driving markets. And we have seen most of the time when we've had fears around escalation of tensions, a kind of flight to quality bid, and we've seen rates rally, so yields lower. Is that how are you thinking about the potential escalation of tensions in the Middle East going forwards? Do you think that this is a pure flight to quality bid that could actually be that trigger for longs, as you've been discussing, or are you starting to get more concerned about the inflationary impact of that too, and the impact that might have on the rate outlook?
Yeah, I'm really skeptical of this one. It's really hard to answer, right? Because I, if you think that any geopolitical risk or supply issues that impact oil, it's a stagflationary impact. We tend to look at it like, well, the Fed will look through it, et cetera, et cetera. The problem is now you've got a lot more room for error on the growth side. If we have a growth hit because of higher energy prices or higher gas prices, the economy's, let's just be honest, economy keeps showing signs it's just ripping along. It's no longer resilient. I mean, it could even be having a step up a little bit from resilient levels of late. Whereas on the inflation side, I don't think the market has a lot of patience for now additional inflation pressures, albeit ones that would be more to headline, not core. It's just that given the prints that we've had and the market reaction to that, I feel like you don't have a lot of room for error on that side. So my worry is that, yeah, I'm sure you will have a flight to quality move, but it could be brief, it could be not lasting, and it could be a situation where people worry more about the inflationary outlook now. And the other thing is there's a question about curve dynamics, whether it is because of flight to quality or um, any sort of geopolitical risk or other reason that does cause the market to need a little flight to quality drive. Did we actually see that in the front end? I mean, if the Fed expectations are somewhat pinned and you don't have any inflationary evidence in the data lately and economy strong, but you have a inflationary shock, if we do have flight to quality, maybe you see it in the long end, right? Where rather than in the short end. So it's a tricky question. I would not, I guess in summary, I would assume that you don't have it like you typically would. And maybe if anything, you see it maybe further out into like the intermediate part of the curve and not a knee jerk just by the front end type reaction, because the Fed will in turn have a more dovish reaction. That reaction function may be changing.
There's also been a pretty heavy UK data week this week, Imogen. Last week we were talking about how this week's data could be a bit of a catalyst for dovish repricing in the UK. Is that what we saw this week?
Yeah, I think for someone that spent a lot of time on this podcast last week thinking that the data could be a trigger for a dovish repricing, it was actually a little bit disappointing in the sense that if you look on the surface, we had an upside surprise on wage inflation, we had an upside surprise and kind of across the board on the inflation measures in terms of headline, core, and of course the service price inflation print as well. But I do think it's probably important to contextualize those upside surprises. I mean, in the first instance, all of them were small. It was a 0.1% beat on headline wage inflation, that average weekly earnings number, and on headline inflation. In the context of inflation data, that comes after 2 months of downside surprises. So it's not exactly a seismic miss, and particularly in the context of the data that we've seen in the UK over the last 18 months. 18 months ago, we would have been quite happy with just a 0.1% in either direction, upside or downside surprise. So it's difficult to argue that this wasn't a relatively well-behaved set of data, and especially on the inflation side, when we think about this versus the BOE's projections for Q1, inflation will now be below the Bank of England's projections, and of course that was a set of projections that they published in February at the NPR just kind of 7 weeks ago, and the same set of projections that implicitly endorsed 75 to 100 basis points of easing as being kind of consistent with reaching a 2% inflation target over the forecast horizon. On the labour market side, of course, as well, the upside surprise on the wage inflation was offset by weakness on the employment side. We got a rise in unemployment that was larger than expected. And whilst markets tend to pay, or have tended to pay, less attention to the kind of employment data as a part of the labour market set of statistics, partly because the BOE and PC have highlighted kind of wage inflation as a key measure that they're looking to as a gauge of persistence of inflationary pressures, partly because of there's still question marks around the labour force survey data in the UK. But in theory, that weakness on the employment side should actually lead what's happening on the wages side, and so this a loosening of the labour market is indicative of reduced wage inflationary pressures going forwards. So I think it's important really to remember that whilst we saw upside surprises on both sets of the data, it is still data that is trending in the right direction. I said last week that I hope that this week's set of data would be a kind of key catalyst or a key moment, I suppose, to highlight the divergence between the UK and the US data. And despite the fact that they came slightly higher than expected, I think it still did that because, like I say, this data is still trending in the right direction. I guess to put that into context, even with our updated inflation forecasts after the data this week, and factoring in kind of higher commodity prices and our slightly upgraded growth projections, we still have headline inflation in the UK falling below 2% in 2 months' time and remaining below 2% for the rest of 2024. Which is quite a different outlook to what we have in the US, where we don't have headline or core inflation below 2% for the whole of our forecast horizon. So through the end of 2025, we don't see inflation in the US getting below 2%, whereas we see it staying below 2% for the rest of 2024, almost essentially in the UK. And then similarly, I think the employment data also highlighted the kind of differences between the labour market backdrops. One of my favourite charts this week, I think, which really highlights the point that one of our sales colleagues made, was the percentage of job losses across industries. And you can see that in the UK, that's been trending up significantly. And actually, after this week's labour market data, we could see that there were job losses across 80% of the sectors of the labour market. And in the US, that number is just 20%. So there's much more evidence of kind of broad-based loosening in the labour market in the UK that we just don't see in the US. So I think the bottom line for me is that whilst the data this week represented kind of slightly stickier inflationary pressures than we had been expecting, it's still trending in the right direction. It's still painting a very different backdrop to the US, and it still paves the way, we think, for an August cut, which has kind of been our base case view for the Bank of England since basically August last year or late summer last year, at a time when everyone was telling us it was far too late. But we hold that view that the Bank of England will still be able to cut rates by the summer this year, we think.
And in terms of gilts, do you still think that cheap relative to fair value at this point?
Yeah, is the short answer. I really like the way that John put it actually when he was kind of talking about the level versus the time, because, I think we've done in yield levels, we've done pretty much a round trip almost when we look at kind of 10-year gilts today versus where we were last week when we recorded Bondcast. And of course, I spent probably too much time then arguing that I thought they looked cheap. And so, of course, it's difficult to say now with data that, like I say, wasn't particularly different to what we were expecting, that they don't look cheap. And if anything, maybe I have slightly renewed conviction in that view, just because part of the reason why I think they look cheap is because, to a certain extent, longer dated yields are a function of what's being priced at the front end. And I think that front end pricing is still wrong. The market's still pricing in far too little easing from the Bank of England, and we've priced out a little bit more this week after the data. But I think similarly to what John was saying, that you're going to be hard pressed at this point to price out all easing from the Bank of England this year. Once we're starting to get to levels which look quite stretched in terms of bank rate pricing. I think we saw that in the market reaction after the CPI data. There was a limit to just how much further the market could sell off, even after a beat on CPI, which followed a beat on the labour market data. And I think that, you're without another month of data that's kind of moving in the wrong direction, which wasn't what we had, it's going to be very difficult for markets to move in a materially more hawkish direction from here. And so that gives me a bit of renewed conviction that actually longer dated rates are starting to look cheap to fair value as well. But here is where the kind of level versus time thing comes in, is that in the near term, I do think it's somewhat difficult to see a catalyst for a shift in, let's say, 10-year gilts from where they are now at kind of 4.25 as we're recording, back towards 4%. We've taken out a little bit of froth in the market, and a turn in sentiment can help that. But it's not an insignificant move to go from kind of 4.25 back to 4%. And, when we look at the calendar now in terms of what we're looking for that might be a catalyst, there's a bit of a kind of data dearth, I suppose, over the next week or so. We don't get the next kind of important piece of data, arguably might be US PCE, which isn't for another 8 days from here, I think. You get European CPI, but I'm not sure that that's necessarily going to move the needle. I think ECB speakers are running out of ways in which they can say that they're going to cut rates in June. And then beyond that, it's back to another round of monthly data, NFPs, the FOMC, the BOE. But that's still a few weeks away. So it feels to me like we could be in some ways treading water a little bit. And of course, with central banks being data dependent, then the data becomes all important. And in between those important data prints, it's hard to see, outside of kind of shocks on the geopolitical front or headline risk around that, what's really going to drive sentiment all the way back towards what we would consider, fair value for gilts at 4%.
And just looking forward to the next week as well, we do get public finance data in the UK, which brings with it alongside a revised gilt remit as well for the current fiscal year. So you're expecting any big changes coming next week?
We don't tend to get major revisions, I suppose, at the April update to the remit, but this month could be a little bit interesting, in part because borrowing overshot quite significantly in February. So it looks like there's going to be an overshoot in borrowing for the full year, which of course implies more borrowing needs for this current fiscal year that we're in. There's been a lot of discussion around this. Some of the projections for how CGNCR, the central government net cash requirement, might be above expectations, became quite lofty, I think, after the February data last month. But actually, when we look at the numbers, I think the increase in borrowing might not be quite as bad as feared. So we still see an upward revision probably to CGNCR in the region of 10 billion. I think there's upside risks around that, but our sort of central scenario is that gets revised up to 10 billion. But there's a couple of offsetting factors. The DMO overfunded slightly into the end of last year. There was a fair amount of take up in the post-auction option facilities, and they had that slightly bigger than expected linker syndication in the last quarter of the year too, which means we're about 2 billion, they raised an additional 2 billion essentially versus funding requirements in the last fiscal year. And also NS&I, the National Savings and Investments Vehicle, the kind of one of the ways in which the Treasury is able to tap into the retail market to rely on funding in the UK. They issued a bond with a very attractive interest rate back in the end of summer last year or the beginning of autumn last year. And that saw a significant amount of inflow. So actually the kind of take up or the funding via NS&I is running a little bit ahead of target for the fiscal year just gone. So all in, I think that should result in an upward revision to borrowing of the fiscal year we're in now of about 6 billion with upside risk. But, 6 billion in the context of 250 billion isn't especially large. But again, when I talked earlier about looking for a kind of catalyst for a repricing lower in yield, upward revisions to borrowing in the same week that we have a long end syndication perhaps aren't the catalyst that we'd be looking for. And then just finally, if it is in the region of 6 billion, I would expect that all to come via an increase in gilts and probably spread pretty evenly across the curve. If that number is bigger, if we're talking closer to the region of 10 billion in terms of additional financing needs required, I think some of that could actually come via bills. Maybe we're talking half of that via bills and the remainder via gilts, again spread equally roughly across the curve, such that the proportions remain broadly similar to what we saw that was announced in the remit in the spring budget. Anyway, that's probably enough from me on the UK side. So Joann, let's switch over to you on the European side. Away from monetary policy for a little bit, we've had lots of discussions over the last week also about EGB spreads and I think European government bond spreads. And France in particular has been a hot topic of discussion, not least because we get some rating reviews next week and then I believe another one at the end of the month. And of course, all the headlines around the increasing deficit and the fiscal risks has left the market nervous, I suppose, about these rating reviews and also more generally about what the fiscal risks imply for French government bond yields. What's your take on all of this and how likely do you think a downgrade might actually be in those rating reviews?
So yeah, like you said, we've had quite a lot of discussions on the French deficit and what that means. I mean, the French deficit was revised upwards both for 2023 and for 2024. So I think the overall picture for the fiscal situation in France is not necessarily a positive. That being said, I do think that ratings reviews tend to lag the market a little bit in terms of when they come in and when there actually is a downgrade. So I do think most of the risks should be priced at this point. Next week, we get rating reviews from Fitch and Moody's. I think Fitch had already downgraded France last year and have said that they need another significant deterioration for a downgrade in outlook to come once again. So I think in terms of Fitch, the impact or the outcome next week should be a pretty much unchanged rating. Moody's should be more interesting just because they have said that France has now overshot their own fiscal deficit targets for France and had already accounted for some fiscal slippage. So we could see a shift in the outlook for Moody's from a stable outlook to negative there. But I do think the more interesting one will come with S&P at the end of May, where they have had France on a negative outlook for quite some while now. So I think that a shift in the rating could be possible for the end of May. But obviously, in shifting the rating, the S&P is only moving it down a notch from AA to AA minus. So it doesn't have very many implications in terms of the status of French government bonds. They will still remain high quality. And I think that's probably what the market will be most worried about. That being said, I don't necessarily see a particularly positive picture for OATs or for France for the rest of the year. There obviously has been concerns about the fiscal side of things. Net supply for France is also more elevated than the rest of the EMU 10. So supply obviously is an important component and should continue to weigh through the year. And I think to add to that, there's also been an increase in the far right in the polls in France as well. So I think there's lots of different factors that make us a bit more negative France in general. I think the difficulty with being short OATs versus bunds, for example, is just that we think general risk sentiment should be positive for EGB spreads this year, given that the ECB is likely to cut. So whilst we are negative the outlook of France, we do prefer to express that view other EGB spreads versus via Germany at this point.
What about Italy? Of course, when we're talking about fiscal risks and elevated supply, it's difficult to ignore Italy within the European space as well. Generally, spreads have performed very well. I guess, like you say, this kind of theme that the ECB is going to cut first and perhaps cut the most this year has helped spreads in general perform. But do you expect this outperformance of BTP spreads to continue?
So like you said, risk has really performed through the start of the year, and we've had a bit of a pullback recently. But to me, it seems that with the ECB cutting rates this year, it's fairly difficult to be negative spreads at this point. I think obviously in Italy, there are negative headlines on deficits as well. There are these concerns about the super bonus in Italy and implications that might have on supply. And of course, there are questions as well about politics and the EU elections and how that filters through. But I do think overall the picture for Italy is a little bit better, just because I think that, as we've seen in the past, Italy has been able to make use of retail funding, particularly last year when EU funding was not coming through. They were able to use the large amount of demand for government debt from the retail sector to make up for some of that lost supply from the EU. I mean, and I think this year, if they are able to get retail supply and if they are able to use EU funds, that should help to offset any kind of increase in supply if that is required because of the super bonus. So I do think net first in terms of supply and fiscal deficits, it might be higher, but I do think that Italy is able to absorb that a little bit better. I also do think that in terms of EU elections and in terms of having a potential excessive deficit procedure put in place for Italy, that's not necessarily a market moving factor. It doesn't really feed into things like the TPI, the transmission protection instrument that the ECB has in case of a widening in spreads. So I don't necessarily think something like an excessive deficit procedure would have an implication for the spread either. And obviously, PEP's rolling off at the middle of the year, but that PEP reinvestment and the way in which the ECB takes out redemptions or stops reinvesting redemptions is actually a smoothened process. So it shouldn't mean that we get a bumpy profile in terms of redemptions or the ECB not reinvesting. That means that spreads widen. So I think overall we are pretty positive Italy at this point, just because, like I said, even with fiscal risks, I think there's quite a lot working the other way around to help support the spread into this year.
I guess we can make it through a whole Bondcast episode without completing our trio of central bank discussions. So we've had a lot of chat from the ECB this week, or from lots of policymakers, given most of them seem to be in Washington at the IMF this week. I said earlier that the ECB are kind of running out of different ways to say that they plan to cut rates in June, barring a major surprise. But markets have now pretty much perfectly priced June, I guess, and are pricing in 75 basis points in total of easing in 2024. What do you think of that level of current pricing? And I guess what will you be looking for as a catalyst to either change your view or change market pricing meaningfully, do you think?
So like you said, Imogen, I definitely think that we've just got this message constantly from the ECB that they're going to go in June, and regardless of the fact that they will be cutting in June. I mean, I think it was pretty interesting when Lagarde was discussing why she would cut and why European inflation is so different from US inflation. She mentioned obviously fiscal policy, but also just difference in the behavior of consumers in the US versus the euro area, where she noted that post-COVID, US consumers had been saving a lot less, whilst European consumers were saving similar levels to pre-COVID. So there's this difference in consumption patterns and in European inflation that makes it right for the ECB to cut in June. But I feel like there's not really a discussion about whether they go in June at this point. It's more about how much they cut. And obviously, I think ECB pricing is at the more hawkish end of our expectations. So 75 basis points, we expect 100 basis points in cuts. But to me, with the Fed looking likely to delay that cutting process or perhaps even not cut rates, it does seem a bit difficult for me to see a catalyst for the ECB's pricing of 75 to shift more in line with our expectations and more towards 100. I think the catalyst will come particularly if European inflation starts to surprise significantly to the downside. So implying that the ECB needs to cut quicker than the markets are expecting for now, given that inflation is actually moving too low. Or, as John mentioned, a series of US inflation prints that actually signify that the Fed might have to cut ahead of where markets are pricing at the moment, and pricing in more than just 40 basis points for the Fed. So I do think there are a couple of catalysts that could actually come to work in favor of 100 basis points. But I do think for now, it seems to be that 75 should be the go with at this point.
That makes sense. Okay, I think that's enough for this week. Thank you both for joining me. Thank you, John, for coming on the pod again. It was nice to have you back. And we will catch up next week. Thank you to our listeners for listening in and watching. If you're watching, just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.